Hi and welcome to this training. So the major factor within trading is knowing market structure and looking for patterns in the Forex market. Now we do this all the time in nursing, looking for patterns of health or deterioration in health and what we need to do to correct those. The market likes to be corrected all the time, so when there's a move up, there's generally a move down to a corrective. The market likes to be in balance of buys and sells. What we'd say in healthcare would be in equilibrium. The markets like to be in equilibrium as well. So in this market structure here, we have three major patterns that we see. Is either an uptrend, which we can see here, going higher highs, higher lows, higher highs, higher lows, higher highs. Then the market might get to a place where it's happy to trade sideways, or also known as consolidation or trading within a range. Okay, and then we have a downtrend, obviously the opposite to the uptrend, lower lows, lower highs, lower lows, lower highs, lower lows, going back to another price point that the market likes. So here's the example with the candlesticks of an uptrend: higher high, higher low, higher high, higher low, higher high, higher low. Now this is a very neat pattern of an uptrend, but it can be less conformatory, if that's the right word. But generally we're looking for an uptrend like that. Now we can see also this is now a range. As you can see, the market is happy to trade within this lower price and higher price, and we can trade these prices when they get to the top. We know they might come back down again. This is called consolidation. Conversely, here we have a downtrend. Starts up here, lower low, lower high, lower low, lower high, lower low, lower high. Okay. Now, what we need to be aware of is these prices are fractal. The same patterns happen on every time frame: daily, weekly, hourly, 5 minutes. So as you can see here from the previous slide, this is zoomed in. These are hourly charts, so this would probably take a week to play out. Whereas within just this, what we call a leg, if we look here, you have the same price pattern within that leg. But these are 5-minute charts, so this might take, if these are 5, this might take a few hours to play out. So the same patterns of higher highs, higher lows works throughout the different time frames. Now when we're looking at candlesticks, the anatomy of a candlestick is what's happened within that time frame. It's extensively used for candlestick analysis. The candlestick patterns reflect the market emotions. Is there fear of buying, fear of selling? It indicates changing sentiment, giving early signs of signals of a trend reversal or continuation. Shows the opening price, the closing price, the low and the high for a period of time. So if this was an hour, the market opened at this price, it drove the price up, came back down a little bit and closed. This would be a bullish or a buying pattern. Whereas here, the market opened at this price, moved all the way down to a low, and then came back up again. But overall, it closed lower, so the sellers were more in control. So then we have patterns that show a change in direction or an exhaustion in the market. These are what we're looking for when we're trying to place our trades. This formation of a pattern is in an uptrend, indicating the top of a formation. The market opens above the previous close and ends below the previous open. So it opened above there but actually closed there, so the sellers are in control and then continue to be in control. This is where we would place our sell signal there, with the risk of stop loss above there, looking to drive with momentum of that market movement. Another pattern very similar is the bearish evening star. This again is a reversal pattern. When we've had an uptrend, we're now looking for the market to be exhausted, turn around for the sellers to take control, and we can move with that emotion. These are normally at support or resistance levels, or a level that has been traded before, either through the banks or central government. These things we will discuss at more detail in the pro version of this course. So this is what we would use for is selling. The stop above the high and determine where the target might be. So we're looking again, if you've read the book, which you all should have done, we'd be looking at a 2-to-1 risk to reward as a minimum. Excuse me for the ambulance going by. Now, these are all selling patterns. Here we can see the opposite of that, which is an engulfing bull pattern. This formation of the pattern is in a downtrend, indicating the bottom of the formation, and the market's likely to reverse and come back up again. As you can see here, the sellers have been in control, the buyers have overwhelmed the sellers, and the continuation then in an uptrend. You can see here twice the sellers have come in, bounced off, come back in again. This is an engulfing pattern, so we're now looking for the price to start to reverse, and we can buy at these places here. That would be a good place to buy, stop below the low, and continue with this trend up. Again, with a bullish evening star, same pattern is a little bit more extreme because the sellers could not go further than this. There was a bit of a gap. Nobody else wanted to sell at that price point, so then the buyers stepped in and bought that currency at that price, driving the price up. Now, I've done a quick video. You can watch that next. And can you identify which pattern was used to take that trade?
So one of the strategies we use is the ADR or reversals using the pattern Marton software. We first go to the expert advisors. Obviously we've already downloaded this. We drag this over to the screen and we'll get a file like this, Marton, inputs, how much we want to risk, and the take profit ratio. So here it's 2-to-1, so we're risking 0.25% and we want 50% back. Okay, so what we'll do is close that out, go to draw trend line and just draw that underneath there. That's all we need to do. What will happen is when this triggers, hopefully in a few minutes, it will put the stop loss above the most previous high. We're expecting after this big long push up to now come back down again. And then we'll have to pause this until it triggers. This a little bit bigger. You can see it. We should just pause this until it triggers. It's just about to trigger now. There. So it has now triggered. Put in a stop loss above here and the take profit there. I just go to the terminal trades. We're now in this trade. It's automatically calculated the lot size, where the stop loss is, and the take profit. We will pause this and come back in a few minutes. So I've come back a few minutes later. It's about 10-15 minutes. So these are 5-minute candles, so it's like about 15 minutes later. We see a £26 in profit. To go to complete profit level would be 249. Could leave this running, but this is just an example of how the pattern Marton makes it easy. Put a line under where you expect price to go, and let it do automatically, take the trade, put in a stop loss. We'll look now 45. Start to go down a bit now, but this is back in 10, 20 minutes, a little bit more. So that one to 50, close it out, 56, 60. And I'll just close this out manually at 50 pounds. 52. We'll just close that out there. So then the lines disappear, and we have now got, we started off with 50,000, we just made another 50%, 0.1% of the account. And that's it. Thank you very much.